Welcome back to Smart Stock Sam, the channel where we break down Wall Street's biggest moves with surgical details. And today, we are diving deep into one of the most explosive setups I have seen all year. We are talking about AMC Entertainment, a stock that just staged an almost 90% recovery rally in a single month. A company sitting on a powder keg of short interest, a gamma wall priced to detonate, and a debt restructuring that has completely silenced the bankruptcy crowd. Is this a real fundamental turnaround or a high-stakes volatility trap that could burn latecomers to the ground? We are going to answer that by walking through the equity research for April 21st, 2026, looking at 4 specific catalysts: the technical picture, the options chain mechanics, the risks you cannot afford to ignore, and finally, a precise trade setup with exact entry levels, targets, and a stop loss. Stay locked in, because the window on this one may be shorter than you think. So let me ask you something right out of the gate. What would you say if I told you that while most of the market was distracted, AMC quietly posted its strongest 5-day stretch in its entire 106-year history? Not its strongest quarter, not its strongest year, its strongest 5-day stretch ever. That is not a rumor. That is a data point sitting right there in the report. And it happened because of one film, the Super Mario Galaxy movie, which pulled in $628.7 million worldwide in just 2 weeks. To give you some context, that kind of opening is the kind of event that the entire theatrical exhibition industry waits years for. AMC's auditoriums were packed, the popcorn was flying, and the revenue was stacking up fast. But here is what makes this more than just a one-film story. AMC is not relying on a single blockbuster to carry the entire thesis. There are actually 4 distinct pillars holding this rally up, and I want to walk you through each one carefully, because understanding all 4 is what separates a thoughtful trade from a gamble. Pillar 1 is the record box office performance we just talked about. Pillar 2 is a massive balance sheet fix that changed the entire narrative around AMC's survival. Pillar 3 is a strategic endorsement from the CEO that could stabilize the entire film pipeline going forward. And Pillar 4 is the quiet, high-margin alternative revenue stream that most people are completely overlooking. Exclusive merchandise programs, Netflix screening partnerships. These are not flashy headlines, but they are sticky, high-margin revenue lines that compound over time. Taken together, these 4 pillars represent what I would call a multi-front assault on the bear thesis, and the bears have been on the run ever since. Now, let us talk about the single most important development in this entire story, because if you miss this, you miss everything. AMC's subsidiary, Odeon Finco plc, just closed a $425 million term loan at a fixed rate of 10.5%, with a maturity date pushed all the way out to 2031. I want you to really absorb that. The maturity wall, the thing that was going to force AMC into a corner, has been pushed back 4 years. Now, 10.5% sounds like an expensive rate, and it is. But that is not the point. The point is that AMC has bought itself time, and in the world of high-debt turnarounds, time is the single most expensive and valuable commodity you can own. This one move has completely flipped the market's mental model of AMC from "will they survive the year" to "how much can they earn by 2031?" That is a seismic shift in how institutional money is going to underwrite this stock. The bankruptcy whispers have gone quiet, and when that happens, short sellers get nervous, and you can see that nervousness reflected directly in the price chart. We started this journey at a soul-crushing 52-week low of just 93 cents. At that level, the market was pricing in a near-total collapse. No recovery, no survival, just a slow bleed to zero. But as those 4 catalysts started stacking up, the price began a disciplined and aggressive climb. And right now, we are sitting at a close of $1.83. That is not just an impressive percentage gain. It is a structural, technical breakout. AMC has now cleared both the 100-day moving average, which sat at $1.37, and the 20-day simple moving average at $1.75. For the first time in a very long time, the short-term trend and the medium-term trend are pointing in exactly the same direction, up. When the moving averages align like this after a period of suppression, it tends to attract momentum-following algorithms and institutional attention simultaneously. That is a powerful dynamic. Now, the natural question is this getting too frothy too fast? Let me show you what the oscillators are actually telling us right now. The RSI, the Relative Strength Index, is sitting at 62.86. In plain English, that means the stock is strong, it is gaining momentum, but it has not yet hit the overbought danger zone of 70 or 80. There is still room to run before the buyers are considered stretched. Meanwhile, the MACD, which measures the acceleration of momentum, is sitting at 0.073, confirming a bullish crossover. Both indicators are pointing the same way, and neither one is flashing a warning light yet. That is a rare and valuable alignment. But here is the thing about momentum. It always hits a wall eventually. And for AMC right now, that wall is very precisely defined. The current price is hovering right around the $1.82 pivot point. Below us, the key support level is $1.50. That is where the 100-day moving average and historical consolidation converge. If the stock pulls back, that is your safety net. But above us sits the level that every trader, every short seller, and every options market maker is watching with enormous attention. $2 even. This is not just a round psychological number. This is where the battle lines are drawn. Sellers are massed there. Short sellers are dug in. And as we are about to see, the options market has created a mechanical setup at that $2 level that could turn a normal breakout into something far more violent. Let me give you the short interest picture first, because it is the fuel. Right now, 15.39% of AMC's float is sold short. That is 88.88 million shares actively betting against this company. And the metric that really matters here is the days to cover ratio, which sits at 1.89. That means if every single short seller tried to exit their position at the same moment, it would take nearly 2 full trading days of average volume just to fill those orders. If the price punches through $2 with conviction, those short sellers do not get to exit calmly. They are forced to buy shares in a rising market, which pushes the price higher, which forces more short sellers to cover, which pushes the price higher still. That feedback loop, that is a short squeeze, and the options market is sitting on top of it like a loaded spring. Here is where the data gets genuinely extraordinary. On April 17th, call options accounted for 93.01% of all options transactions on AMC. Think about that number. 9 out of every 10 options trades were bullish bets. And look at where the money is concentrated. Over 48,000 contracts of open interest are sitting at the $2 strike for the April 24th expiration. Another 13,000 contracts are stacked at $2.50. This is not scattered, casual speculation. This is a massive, coordinated concentration of bullish conviction, and it creates a very specific mechanical phenomenon that most retail investors never learn about until it is too late. It is called the gamma effect, and I want to walk you through it carefully because this is the hidden engine behind what could be an explosive move. When you buy a call option, the institution or market maker selling it to you has to manage their risk. They do that by buying shares of the underlying stock to stay delta neutral. As AMC's price approaches that $2 trigger, those market makers are not sitting still. They are being forced, mechanically forced, to buy more and more shares of AMC to hedge their exposure. More shares bought pushes the price higher. A higher price means the options are getting closer to being in the money, which forces market makers to buy even more shares, and the retail call buyer's conviction accelerates the whole cycle. This self-reinforcing loop, the gamma squeeze, can push a stock far beyond what the fundamentals alone would justify. And with 48,000 contracts clustered at exactly $2 expiring in days, the trigger is loaded. And here is something that is relatively new to this story. Wall Street is starting to agree. For a long time, AMC was a retail versus institutional battle. The institutions had the sell ratings, the retail army had the meme stock enthusiasm, and never the twain shall meet. But look at what happened on April 17th. B. Riley Securities officially raised their price target to $2. Institutional targets are beginning to align with the exact same level where the retail options positioning is concentrated. When the smart money and the crowd are pointing at the same number at the same time, that is not a coincidence. That is a signal. But I would not be doing my job if I did not lay out the real risks here, and AMC has some serious ones you cannot sweep under the rug. First, there are active class action lawsuits connected to the AMC preferred equity units, the APEs. Investors are alleging that technical loopholes were used to exclude them from special dividends. If these suits gain traction, you are looking at a genuine financial and legal overhang that could weigh on sentiment for months. Second, there is a pending $150 million equity distribution plan still hanging over the stock. Whenever AMC issues new shares to raise cash, it dilutes existing shareholders. The question you have to ask yourself is, will the momentum be powerful enough to absorb that new supply without breaking the rally? And stepping back even further, the long-term fundamental reality is sobering. AMC still carries $7.55 billion in total debt. They are still generating net operating losses. For this story to have a happy ending over a multi-year horizon, they essentially need the 2026 film slate to deliver hits at the same velocity as Super Mario Galaxy, which is asking a lot of any studio lineup. What gives the bull thesis its legs in the near term is $43.3 million in free cash flow generated last quarter. That is real money. It is a runway. It buys the speculative momentum thesis the time it needs to play out. But this is not a retirement investment. It is a momentum trade with a very specific setup and very specific risk parameters. And you need to trade it that way. So let us talk about exactly how to do that. If you want to play this setup, here is the blueprint. Your entry zone is between $1.85 and $1.90. You want to see a confirmed close on the hourly chart above the current pivot before committing. That proves the buyers are controlling the tape and not just testing the level. Your primary target is $2 even. That is the major psychological wall, the options concentration point, and the institutional analyst target all in one. If AMC breaks through $2 on high volume and the gamma squeeze triggers, the secondary target is $2.50. Where that next cluster of 13,000 open interest contracts is waiting. And to protect yourself if the rally stalls, a stop loss at $1.65 is non-negotiable. That sits just below the 20-day moving average and gives you a clear signal that the momentum has failed. What makes this setup compelling from a professional trading perspective is the asymmetry. You are risking roughly 20 cents per share on the downside to potentially capture 65 cents to $1.50 on the upside. That kind of risk-to-reward ratio is what serious traders spend weeks looking for. The final verdict on AMC is this. It is a high-probability volatility opportunity, and the setup has rarely been this clean. The catalysts are aligned. Record box office, a debt extension that removes near-term bankruptcy risk, and the film pipeline potentially stabilizing with the Paramount-Warner merger. The squeeze mechanics are fertile. 15% short interest, a gamma wall at $2, and a market that is 93% bullish on calls. The key is playing it with discipline. Watch the $2 wall like a hawk. Use your stop loss. And never, ever confuse a momentum trade for a long-term fundamental hold while $7.5 billion of debt is still sitting on that balance sheet. Before I let you go, I need to be very clear. Nothing in this video is financial advice. I am not a licensed financial advisor, and everything you have just watched is for educational and informational purposes only. All investing involves risk, including the potential loss of your entire principal. Always do your own due diligence. Consult with a qualified financial professional before making any investment decisions, and never invest more than you can afford to lose. Past performance is not indicative of future results. Smart stock. Sam does not hold positions in any securities discussed unless explicitly disclosed. Now here is the question I want you to answer in the comments below. If AMC does trigger a gamma squeeze and breaks through $2 this week, do you think the institutional money will chase it to $2.50? Or will the dilution, risk, and debt burden force a hard rejection right at that wall? Drop your analysis down below. I genuinely read every single comment, and the best responses get featured in the next video. If this breakdown gave you something useful, please hit the like button right now. It takes 2 seconds, and it tells the algorithm that this kind of deep dive research content is worth pushing to more people. If you are new here, hit subscribe and turn on notifications so you never miss a move before it happens. And if you really want to support the work we are doing on this channel, the late nights, the data pulls, the research, you can send a super thanks using YouTube's built-in support feature right below this video. Every single contribution goes directly back into making this content better, faster, and more precise. This is Smart Stock Sam. I will see you in the next one.